Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with the last edition of the weekly economic review for 2022. We'll be back in January, early in the year, but next week we'll be on holidays and taking a week off from the review. So we'll talk again about inflation. We'll talk about housing, odds of a recession, the market. So the themes of 2022, they are bringing us into 2023. Now let's start with a look at this week's markets at the close on Thursday. So a negative week again for bonds. Interest rates up a little bit on the week. Maybe some oversold conditions in the very short run. Stronger confidence in the U.S. pushed the risk sentiment a bit higher on the week. But year to date on the right, of course, there's about one more week to go here. But this is the ballpark where we'll end up about minus 10% on bonds, about minus 20% for long bonds, so a negative year for fixed income. For equities, the TSX never went into a bear market. So a bear market is when an index pulls back from its recent peak by 20% plus. Never reached that in Canada. And in fact, we're ending the year about 5% negative. So very positive development here, outperforming to the downside, but still an outperformance from the TSX based on more affordable valuations in Canada. In the US at about minus 17% now, but definitely still in bear market. NASDAQ the same thing. If you look at the price of oil, pretty much zero on the year. So as you see, 5% this week, 4% year to date. So that means that we're pretty much at the same level as we were. The USD was up 10% on the year, and the CAD was down 7% versus the USD, meaning that the Canadian dollar was actually strong versus other currencies, but the strength of the USD was very impressive this year. Euro down versus the USD, and the price of gold going nowhere year to date. So if in your strategy you thought, well, inflation, so I should buy some gold, well, at least it wasn't deep negative, but that was not a winning strategy in 2022. So let's start with, again, the topic of the year, inflation. So we had the inflation figures in Canada for the month of November. So inflation ends the year on a sticky note. And here, this is the same chart I've been using most of the year. You see all of the components of inflation there. So after reaching a peak this summer and falling down quickly, now we're kind of hitting a plateau. And we see that all of the components here, all of the colors, they're kind of all going sideways. So inflation is rather sticky right now. That's the message. And there's nothing that leads inflation higher or lower. It's just that we have it's going to take some time before inflation goes down to the target. Remember that it's a target range of 1 to 3%. So we should be there somewhere in late 2023 or in 2024. It's going to take some time. And even if it takes some time, that doesn't mean that monetary policy is not working, because monetary policy works with a lag of 6 to 8 quarters, so 1.5 to 2 years. So it takes a while, but in 2023 the story will be how quickly inflation comes back down to earth. But now inflation is sticky, and inflation in services, as you can see in the slide here, is sticky and it's rising. So inflation is in goods is starting to fall, but in services it is more resilient. And services inflation is tightly linked to wages, and wages should be supported by labor shortage over the next years, 5 to 10 years. So inflation in services, it's in focus. The Bank of Canada is mentioning it in its statements. They're targeting it, but it's going to take a while before we get back to 2% inflation on services, likely because of the push in wages. So inflation is here to stay in the short run, and in 2023 we'll look at the speed of how we can get it back to the target. So that's going to be a theme of next year. One of the other themes of next year also will be housing, because monetary policy works with lags, but it also works in a sequence. So at first rates rise, so it stalls housing, and the housing activity, resale activity slows down, prices slow down. That means that the wealth effect of households is negative. So you feel less rich when you see the prices of houses falling. So you spend less. Inflation is also eating at spending power. Rising rates means that it costs more to borrow to buy goods, so you spend less. Then after that, businesses are investing less, they're hiring less, and at some point they start to fire people. And then you have unemployment rising, and that completes the cycle. And this is what brings us to a recession. So we do think there's a recession coming. It's a shallow recession, but a very probable recession. About 3 out of 4 are the odds, we think. So this is where we're heading, and we'll be talking about housing a lot next year. And here, this chart, 6th consecutive monthly decline in Canada for housing prices, as you can see on the left, and the total drawdown on the right is in line with 2008. But just beware that in 2008, Canada did not have a housing bubble. The housing sector did not burst as it did in the US in 2008, and the price of the average Canadian house went up by 50% during the pandemic because of very low rates, because of change of habits and some speculation, of course. So now this speculation will be deflating, so froth being removed, not a bubble bursting. So that means that the drawdown could reach between 15 and 30%. This is how wide our forecasts are. And even if if prices fall by 30%, the average Canadian house will still be worth more than it was in late 2019. So it's just a return of the pendulum. Very low rates pushed housing prices higher, and now it's normal that we get back to something that's more reasonable, and that will avoid a bubble being created. And at some point when bubbles burst, some people lose some real money. So it's normal. It's just an adjustment phase that's undergoing, and it's going to be an important story in 2023. Comparing here to the US, just for comparison, we'll be talking about US housing also a lot in 2023. Here maybe it's just a delayed reaction, but it's just the 3rd consecutive month of falling prices in the US. But look at the drawdown chart on the right. You see this little baby line on the right compared to the abyss of 2008 to 2018. So there was a housing bubble in the US in 2008. This is what the bursting of a bubble looks like, and right now it's very meager compared to that. So, but the monetary policy, the way it works, housing prices down, wealth effect lower, and everything that trickles down from that. Of course, this is going to be the unfolding story early in the year. So now maybe moving to the markets, we are asset managers, so we look at the economy in the markets, and we build views that we implement in portfolios. So I tend to have an optimistic bias, but to correct that, I need to be very realistic, thus the studying of history and thus the use of data extensively. And here, the question that we asked ourselves is it possible that we could have 2 consecutive years of negative returns on Wall Street? And the answer is yes, it's possible. It's something that has some probability. It's not our base case, so we don't think this is what's going to happen, but it's a risk. So we need to position ourselves for that. And we went through history, and we said, all right, what years were consecutive negative years on Wall Street, and how frequent was that? And as you can see, they're bunched together, and there's 4 episodes. Just when the Great Depression hit in 1929, we had 4 consecutive years of negative returns. At the end of the Great Depression, we still had some speculative activity towards the end. Then we had another 3 years of negative. In the mid-1970s, valuation became pretty pricey. Then we had 2 years of negative growth. And 2000, 2001, 2002, of course, the bursting of the dot-com bubble, we had consecutive negative years. So that leads me to this chart here. This is the long-term price-earning ratio, so the cyclically adjusted price-earning ratio. So you're familiar with the PE ratio, price divided by earnings. But here, it's the Shiller approach. So what we do is that we divide by the earnings of the last 10 years just to smooth out everything and have a very long-term perspective on how expensive the market is right now. And if you look at all of the periods that I just mentioned, early 1930s, valuations then were at an all-time high. Late 30s, valuations had come back near the all-time highs. Then the 1970s, valuations were near all-time highs. In 2000, 2001, 2002, valuations had never been as expensive as then. And look at late 2021, we were second to the 2000 dot-com bubble. So it's possible when you have valuations that reach all-time highs, astronomical levels, then that means that the market becomes more vulnerable to episodes like I'm describing here, back-to-back years of negative returns. So we'll see. So our forecasts are for positive but single-digit returns on equities in 2023. We should continue the bear market process that we're in. There's going to be a bottom at some point from which will form a new base and a new bull market will emerge. But December 31st to December 31st, what is that going to look like? It's a big question mark. But for now, we remain defensive. For now, we don't think the absolute bottom is in. When it's time, we will be telling you, we'll be explaining our strategy here. But the odds are positive, slow, but positive, that we could have back-to-back negative years because of the state of valuations right now. So I'll end here. So the calendar next week, there wasn't much anyway, and we won't be covering it. So I thought I'd just skip that. So I just want to say thank you for your continuing support. It's a pleasure to serve you every single week here. ia.ca/economy, the webpage remains there. You can go there and find everything we produced. You can subscribe to the newsletter if it hasn't been done already. Podcast in your interest, there's still ample material coming, and we just posted 2 episodes of a recap of 2022 with my colleague and friend Marc Gagnon, and we also recorded an outlook on 2023, which will be published in early in the year, so pay attention to that. Economy and Finance 101, the material is being produced still, so it's going to come in 2023. And the social media, Twitter and LinkedIn, you can follow me there. So thanks everyone, and I'll be back in early January.